We start, though, as we do now that I'm back, with the morning brief at this hour. And I missed the jobs report on Friday. Luckily, Myles wrote about it in the morning brief this morning and highlighted three charts that may have gone overlooked amidst the hustle and bustle of trying to make sense of the report on Friday. We know the headline number, 850,000 jobs added. We also, as has been the case, have paid attention to the labor force participation rate. How many people are in the workforce right now? Because a lot of people, as we know, are still staying out for a lot of different reasons that we have talked about a lot. But you, for your first chart, Myles, we're looking at a specific part of the workforce and its participation rate.
Yeah, and it's a good thing that we had Shauna Smith on Friday, Julie, because you didn't miss the jobs report. You also would have missed me because I didn't get my camera working until about 9 a.m. But we'll take that offline. So let's take a look at this chart, and this is what they call the prime age labor force participation. So these are workers between the ages of 25 and 54. These are workers who are in an upward trajectory professionally. They are making more money over time. They are the backbone of any economic expansion. These are the people who are having families, spending the most money, entering their prime earning years, and all the associated great things that come along with moving into one's 30s, 40s, and beyond. And so this has been a key part of the market to watch over the last several years, because as we can see on this chart, which goes back a decade, about 80.6% prime age participation is where we fell to in the fall of 2015, the nadir of the post-financial crisis labor market slog. If you go back to the work of Ann Case and Angus Deaton, really the deaths of despair and questions around where these workers had gone, because any healthy recovery must see very high levels of participation. For recoveries gone by, 20, 30 years ago, we saw participation from this cohort upwards of 84% in the labor force. So now to see an uptick last month in labor force participation among prime age workers shows a couple of things. I think a lot of those household responsibility stressors that we've discussed from time to time are being alleviated somewhat. So you can have dual earning households go back to being dual earning households after perhaps one member of the household more often than not the female member of the household giving up some work responsibilities as you had kids at home, so on and so forth. That is starting to go away. So we're seeing an uptick in participation there. But I think the real takeaway from this chart is that if we're going to have a durable growth cycle on the other side of the pandemic, this chart is going to have to look a lot more like it did from 16 all the way through to 2020, where workers at this part in their career are participating in much higher numbers. And encouragingly, we started to see some of that last month.
Yeah, I think it's also interesting, the implication by what is being left out of this chart. In other words, the older folks and the younger ones, because if what this chart seems to imply is correct, that, and what we've heard anecdotally is correct, that a lot of people took early retirement because of the pandemic, then we are going to see that upper age bracket stay depressed for a little while, right? Until those younger people age up into that area, because those people who are retired are not re-entering the workforce in most cases. So that middle bracket's going to have to do even more work to get the overall labor force participation rate up. And you also wonder about younger people and teens in particular. We know overall household wealth, particularly in the upper income brackets, has been rising. So do those teens perhaps have less impetus from those households to go out and get jobs? How long is that going to sustain? So to me, it feels like the burden is even more so in that prime age bracket that you're looking at, Myles, that they're really going to have to be going back to work in pretty high numbers. The second chart, that you're looking at has to do with what's going on in hospitality, leisure and hospitality, which we have talked a lot about, people coming back to work there. And as your chart shows, they're getting paid more.
Yeah, so typically the way that you look at wage data is you look at the year-over-year growth. I chose to look at aggregate wage data, however, for leisure and hospitality workers, which now on average is $18.23 per hour. If you work 40 hours per week, 50 weeks per year, your annual income is around $36,000, a little bit north of that. The poverty line for a family of four in the U.S. is $26,000. Now, the average wage that was being earned in this sector of the economy just 8 years ago was a below poverty level wage. So you are now seeing not only workers in this space pick up wage gains, wages were up 7.1% over the same month last year in June, but are now earning a wage that is starting to get to the kind of annual income that you can actually live on. And granted, $36,000 per year is going to be extremely stressful in many parts of the country and is by no means, certainly you look at the per capita GDP of the U.S., by no means an income that I think people should be satisfied with for workers who are really at the heart of economic growth. But it is a sign that I think, and we heard this a little bit from David Burke in his conversation with Shauna Smith last week down in Times Square, where he was saying, I have to pay my workers in the restaurant a lot more for them to come in because recruiting is tough. Some folks don't want to come back because of unemployment. Some folks don't want to be in this line of work at all because of what they saw happen to their colleagues during the pandemic. But the workers that I do have left, I'm paying more, and now it's a different exchange. I'm investing more in my workers, and my workers can actually make ends meet with this job. And I think as this chart is showing, we talk so much about the year over year rate of change because we're so obsessed, myopically obsessed, I believe, in the financial press with inflation and what it means for the Fed and so on and so forth. But the level of wages is now to the point where we are talking about real incomes that are starting to take a class of worker who had been seen as burn and churn replacement type worker, and it's actually someone you want to invest in, be a team member for years. You look at what Chipotle is doing with trying to get its workers to stick around, for 3 years, and they can be a manager and they can be approaching six figures in income and so on and so forth. And so that's why I looked at the aggregate level, because if we continue to see this average wage for this sector rise, goes to $19, goes to $20 an hour, all of a sudden you're starting to talk about, $40,000 plus in annual income. And now we're talking about, the actual ability to, again, as I've said, make ends meet more realistically than at $13 an hour. And I think that that's a big trend that if it does last, if this is a durable economic trend, it really could reshape the way the balance of power is between capital and labor on the other side of the pandemic.
Myles, two quick observations for me over the weekend. So I'm walking around in my town over the weekend looking for my egg whites and protein shake, and one restaurant has a picture or a sign on their door saying they ran out of staff and they were closed. I go to get my car washed. I would say it usually has about 6 or 7 workers outside cleaning the cars, washing them down. They had 2, and they had to turn cars away. And really, it makes me wonder, at what point is this labor shortage simply going to inhibit and hurt the economic growth? At the end of the day, that restaurant that ran out of workers, they were closed. They couldn't let people in there spend their cash. That car wash that I went to, they were turning away cars. That's less business for them. I do wonder, at one point, do we start to see a growth slow down because workers are not in there working, wherever that might be?
That's what capital would say. I'm not sure that's how workers see it, but yes, if you were a business owner, that's how you see it. Sure.
All right, so let's talk about the final chart, which is the overall employment picture and kind of where we are now versus where we were pre-pandemic.
Yeah, I mean, this one, we've charted this since, obviously since the beginning of this, because it was the most jarring, indicator of how scarred the labor market became in April of last year. 5.8 million is the spread right now between total employment as of February 2020 and where we stand as of June 2021. Now, Julie, earlier you mentioned retirements. Wrote about that in the morning brief last week. Some estimates that upwards of 2.5 million people accelerated retirements during the pandemic. If we subtract that out of the 5.8, okay, so now we're looking at 3.5 million workers fewer, or 3.5 fewer employed workers than we had in February 2020. Maybe that gap gets a little bit smaller, but this chart is one that I expect we're going to bring up every month, because when you look at the way folks like Jay Powell are thinking about a full recovery, a maximum employment type situation. We're not credibly going to be talking about that until this chart until the gap in this chart is closed, right? So until you have at least another 6 million payrolls come back into the economy, that could take 2 months, that could take 4 years. I don't think you're going to find a Powell-led Fed getting too excited about the maximum employment side of its mandate, and so it is, again, just worth highlighting. And I think, because we've talked about this so often, I think people are well aware of this shortfall that we've seen between the February 2020 and today's level of employment. But it is worth noting each jobs report, and I think will be for some time, because again, as I've said, until you are back to, I think it was 106, 153 something million employed workers in Feb 2020, until you get back to that level, you are not going to see a full employment, maximum employment type conversation coming out of the Fed, which means even if you get tapering, even if you get talk about maybe one rate hike, maybe a second rate hike, you're not looking at a cycle, I don't believe, a true cycle of we are embarking on raising interest rates steadily and progressively over some 12 or 18-month period until you have this chart, repaired. And so we'll see if that indeed happens over the coming months and potentially even coming years.